My name is Mike Sullivan. I'm a former IRS agent and teaching instructor. I worked at IRS over a decade. I'm a national expert in IRS resolution and audit matters. And welcome to my YouTube channel. My YouTubes are short, they're sweet, they're to the point. I tell you everything you need to know generally within 5 minutes. I don't give you any fluff. To be honest with you, I'm the gold standard in what you need to know in a short period of time. And I'm going to talk to you today about what triggers IRS audits. There's a lot of articles you can Google. You can Google what triggers IRS audits. You'll probably have, I don't know, thousands of hits that go ahead and trigger IRS audits. I could sit here probably for an hour and start going over every single one. I want to tell you the number one reason that your tax return is audited. IRS has a system where they can pick off low-hanging fruit. Makes sense? Sure it does. They can't go through every single tax return and gee, this is good, this is good. So they use a series of algorithms that they use to determine who they're going to audit and who not. Generally, your W-2 wage earner who files a simple return isn't going to get audited unless they start taking credits. IRS's system and their filters are set up to pull returns that use or overuse tax credits, earned income credits, child care credits, and they will be number one picked. They're usually used by kind of shady practitioners who want to get people big refunds, and they use these credits. Those people are picked off all the time. This is not the audience that I'm speaking to today, but I just want to let you know if you're going to use credits for the IRS, it's like pure cash. They're going to pull those returns for audit if they smell anything. And remember, IRS is all algorithms. They didn't have all these about, I don't know, 6, 7 years ago, but now they're very sophisticated, and they're used usually by people who don't make a lot of money. They're used by people who don't prepare a lot of returns, and usually they're in areas here that you can expect a lot of fraud. So that's the number one thing they look at. But the big reason that I want to talk to you today about is called the Diff Score. The Diff Score is called the Discriminatory Index Function Score. And what that means is your return gets processed and it's given a score. IRS will put your return in the system and out comes your Diff Score. What the Diff Score shows you is how many areas did you fall out of the national average and by how much? How much did you fall out of the national areas and in how many categories? So what IRS does when that return goes in, every return gets a score. IRS then will look at those scores and say, is this real? Does this make sense? So they're looking like stuff like your gross income, your adjusted gross income, your business expenses, deductions you're taking, losses you're taking, and that it just they have to make sense. So IRS's algorithms will let them know how much you fell out of the national average based on the information you gave IRS. And it's very effective. Very few cases that IRS pulls gets what's called an NC, a no change. So what you should do is if you have a tax return you're filing, your practitioner or a former agent should be able to go ahead and look at that tax return and say, something really does not make sense. Huge business losses. Some people end all their tax returns in zero. They're taking large travel and entertainment. You just know by looking at the returns something off. IRS has been perfecting these scores, so at the end of every year they kind of adjust the score, but today IRS is spot on. If you're going to get audited, they're going to look at those issues that fell out of the national norm. So just know that. So if you have business or partnership losses, IRS is really going to be looking at those things. You're going to know yourself what area, believe it or not, you took a little too much advantage. Now, if your return is pure and it's good, go in and represent yourself. There's nothing wrong with that. However, if you have a worry factor or, oh my, there's skeletons in the fact, don't go in yourself. You know why? IRS can expand that audit to up to 4 years. Many agents expand at 3 years. they can go for if there's a 25% omission of income. Remember, IRS is going to be going through your bank statements. They're going to look for income you didn't report, and now they're going to be looking at Zelle and Venmo and PayPal to make sure you picked up all that income. So if you have something to fear, do not go in yourself. You're welcome to call us. We can represent you. Talk to your own CPA, whoever you want to do. But remember, you're going to know yourself how much you cheated or you kind of took advantage on the return. You're welcome to contact us anytime. But if this was helpful, how about giving me a subscription? YouTube really loves subscriptions. It shows that you value what I'm doing. So by the way, you can leave me a comment. I always get back to comments. You're welcome to email me or call me anytime. Thank you very much. I appreciate your time.